Hello and welcome to the latest of our regular market updates. Today, we have a few topics for us to discuss. We'll look at the recent equity performance, we'll talk about the effects on monetary policy and portfolios, and we'll examine some of the curiosities currently affecting the global economy. Before we get started, remember you can subscribe to our YouTube channel to be notified every time we post an update. As the summer draws to a close, the attention of the financial world is turned towards the months between now and the end of the year. More precisely, on whether these months will see any kind of slowdown or change in the trajectory in the markets. As an investment committee, we're primarily focused on equities. Lately, we've been keeping a particularly close eye on the differences in performance between emerging and developed markets. Some weaker performances in emerging countries has been impossible to ignore. Just to give you a sense of it, our ETF on emerging markets is up 7% since the beginning of the year. Compare that with 20% growth seen in developed equities. These numbers have become even more significant when you consider that in mid-February, emerging markets were up 12%. The most influential factor here is China. If you remove the impact of Chinese companies from the index, the performance would have translated to a 15% year to date. A lot of the headlines on emerging markets have focused on China's policy towards the larger technology-based companies, and that seems fair. But we've also seen earnings expectations for emerging markets weaken a little bit. Over the last couple of months, we've seen the Delta variant have an impact on the outlook for macroeconomic variables. In general, macro data has been pretty robust, but maybe not quite as strong as analysts had expected. On the corporate side, we've generally seen companies continue to perform well in absolute terms and relative to expectations. So one topic that we wrestle with is whether we'll see a slower recovery from here in economic terms, and if we do, whether listed companies will continue to report robust results. Having said that, we've already discussed the reasons we believe these issues to be contextual and ultimately transitory. Even if political uncertainty could be considered as a structural issue of Chinese economy, over the medium term, we expect the prospects for emerging markets, including China, to be positive. Now, for investors, the key consideration is whether or not the recent declines have opened up the possibilities on the valuation sides. Prices are low at the moment, if compared with the US and European equities, which could represent an opportunity. But we have to assess whether the discount is sufficient to offset the effect of any political uncertainty on the markets, or if company fundamentals could be compromised in any way. We'll complete our assessment over the coming weeks, and if we think it will benefit our investors, we will act accordingly. Let's turn briefly to performance. The past month has been positive for markets, with the S&P 500 and the Nasdaq hitting new highs, growing by 3% and 4% respectively. Since the beginning of the year, they're up about 21% and 19% respectively. Europe also performed well, with a growth of 2.17% in August and 20% from the beginning of the year. In this context, the equity side of MoneyFarm's portfolio continues to perform positively. We're still in the midst of a unique and transitional phase for the economy. On the one hand, we're seeing a strong, if uneven recovery, and on the other, the pandemic continues to have a knock-on effect despite the broad removal of restrictions. The situation is perhaps unprecedented in the history of economics. This is to say that there are a number of different peculiarities combining to create a unique environment. A catchy, straightforward way of summarising it might be to say that globalisation has jammed. The shortage of truck drivers, problems with shipping, the lack of semiconductors, localised closures in Asia due to the Delta variant, skyrocketing rates for shipping containers. These are all indications that the global trade channels are going through a bit of a turbulent period. For now though, the job market remains the most interesting economic mystery in recent months. Even in countries where emergency financial aid is being stripped away and labour shortages continue to put pressure on the supply side, somewhat limiting economic recovery. So, we're seeing inventory problems and producer prices rises, all against the backdrop of an uncertain economic outlook. If the strong recovery on the demand side stays strong and the supply side is unprepared, this could create an environment for inflation. There are two key theories here. One is that these organisational bottlenecks will be temporary and the situation will normalise over the medium term. And on the other hand, there are those who predict that the labour market could settle on a higher long-term wage level. Let's also take a look at the monetary policy. The recent Jackson Hole Symposium was something of a non-event as far as financial risk is concerned. The much feared hawkish turn failed to materialise, with the Fed chairman, Jerome Powell, going to great lengths to dismiss concerns about inflation, and managing to separate the decision to reduce the amount of bonds that the Fed will buy with the decision about interest rate hikes. Now, Powell also made it clear that the current supply chain bottlenecks were outside the remit of the Fed, meaning there's very little reason to suggest that a less accommodative stance would solve the issues. Away from money markets, financial markets took the events in their stride. Realised volatility remains low, with equities and fixed incomes seeing no dramatic changes. The important thing is what comes next. The job market continues to send mixed signals, while the coming weeks will give us a better idea of the directions of the economy going forward.